Crypto crash is trending on Twitter, and you know what that means. Lots of crypto memes and very little in the way of actual data or information to tell us why the HE double hockey sticks is crypto having such a rough time. After all, this rough time really started around the time of June when Jim Cramer started getting a little rough against, crypto in general on Twitter, and then it was seen as a buy signal. You know, generally people have taken a contrarian take on Jim Cramer and thought, hey, if Jim's complaining about crypto prices in June, it must be a sign of the bottom. And it was for a brief period of time as we retraced from about 17,596 back to a high of about 25,300 for BTC mid-August. Nice rally that sort of corresponded with what was going on in the NASDAQ, but we only made it from a 0% retracement to a 23.6 retracement. That's not very good. Now, in nominal terms, we went from went to 25 from about 17.5. That's about a 42% gain. That very, very nice, especially when you compare it to the indices. Certainly a far cry from what we've seen at the top of the market back in November of 2021. So when we look at the retracement lines from that point of view, it doesn't look like we're getting anywhere, but this is still a 42% gain from bottom. But why is it then that we're revisiting that bottom? And why is it that now, post Ethereum-merge, we're starting to see pain again? After all, take a look at the numbers. Bitcoin is down 12.57% over the last 7 days. Ethereum down almost 19.5% in just 7 days. Sure, Ethereum's proof of work token, basically old school Ethereum before the old school token, Ethereum Classic, right? Ethereum POW, proof of works, looks like it's up 31.5%, but when you go to what it was originally around $130 to $133, it's actually now only a $6 token. It's lost a lot. Of course, you're going to have fluctuations along the bottom. But again, it's not just these tokens. It's a lot of tokens. Look at Cardano, down to 45 cents. Solana, down to $32, down 12%. Polkadot, down 17%. Polygon, Shiba Inu, Avalanche, all of these down about 18%, 17 to 18%. It's a lot. Even Ethereum Classic dropping as much as 20%. And this is where we're going to discuss 4 reasons why the crypto crash is really hurting right now, especially with Ethereum. And number 1, let's talk about Ethereum. So Ethereum post-merge was supposed to moon. I mean, we're using less than 5% of the energy that we're using before. Some say even less than that. We're saving 95+% of the energy that we're using on proof of work now just to operate a proof of staking protocol. It's really, really quite incredible. And there are lockups for those who have staked their Ethereum into Ethereum 2.0. The problem that we're seeing now, though, is that the miners who are mining Ethereum, who are in the business of making money through Ethereum, now face the potential risk of bankruptcy if they have not properly prepared themselves for this transition. Because unfortunately, even though after the fork to proof of stake, proof of work remained active, miners thought that the valuation of Ethereum proof of work might actually provide some form of income for them to slowly phase out and close their businesses. But unfortunately, when we go from $133 of proof of work Ethereum all the way down to under $6, you don't have a lot of assets left. Now, of course, a lot of Ethereum miners do have money staked at Ethereum 2.0. But a lot of their additional profits, at least from what I'm hearing within the crypto industry, especially from miners, is that a lot of the profits of these businesses were not thrown into Ethereum 2.0. They were reinvested into more chips and more cooling and more space. So that way they could expand their mining operations. And Ethereum miners regularly believed that when the merge came, they would just be able to transition to mining for other proof of work currencies. Dogecoin, for example, is one of the largest proof of work currencies now that Ethereum has moved over following, of course, Bitcoin. Now, that's remarkable because it's Dogecoin, but it's also remarkable because not a lot of people actually transact in Dogecoin, unless, of course, you're purchasing stuff from the Tesla shop in Doge, which is pretty epic, but still kind of an expensive and burdensome process for a lot of folks who are not familiar with transacting in cryptocurrencies. And not seeing a lot of transactions there. Therefore, there's not that much proof of work to actually do. We need volume for proof of work miners. In my opinion, what's happening is you have a lot of these miners who are now liquidating assets, dumping their Ethereum proof of work in almost a fire sale to try to survive. Unfortunately, many of them won't, and many of them will be forced into bankruptcy. And that is unfortunately where the next phase of Ethereum comes from, and that is the post-merge lockup expiration. Sometime between 6 to 12 months after the merge, we were told that Ethereum stakers who put their money into Ethereum 2.0 and waited years for this merge to happen will have the opportunity, probably in tranches, to start selling their Ethereum to the market. Unfortunately, they chose a currently technical recession to complete the merge in, and they may end up having a lockup expiration during an actual recession or maybe even depression at that point, just depending on when the lockup expiration is. Given that there are a lot of folks in the crypto ecosystem who have built businesses on top of crypto, who may have to liquidate Ethereum just to either stay out of bankruptcy or to fulfill judgments or liens, unfortunately, I think there is going to be a lot of selling pressure. Now, I've made videos on this before, the post-Ethereum merge potential selling pressure and how deep the post-Ethereum merge crash could be. Now, that could lead, if you compound that, to about a 35% drop in Ethereum prices because of this excess supply. But the argument that's made in the crypto community is, don't worry, we'll be able to absorb all of that excess Ethereum. Okay, fine, but that's partial withdrawals. And so now, and this is the part that's totally up to speculation, we have to determine how many validators who currently have staked Ethereum, or stakers who are part of validating networks, how many of them are going to fully withdraw from the Ethereum network versus partially withdraw or just straight up hodl. Obviously, if everyone fully withdraws, we'll have problems. But that's also where Ethereum developers will likely have some form of limits. Currently, the limit is 5 validators can withdraw completely from the network per epoch. Remember, there are 225 epochs per day. Now, this limit could change. We might see 10 per epoch at lockup. And the estimate here from data analysts, is the potential of about a supply of 65,000 to 80,000 Ethereum in addition to the partial lockups per day. That, in my opinion, would represent an approximately 10% additional supply hit or an additional availability of 10% on the daily traded volume for Ethereum for probably the first few weeks of the Ethereum merge, which could compound on top of that 32 to 35% from partial withdrawals. Now, that doesn't again necessarily mean that prices will come down this much because again, people could be buying the dip and we could see a lot of stability here. And after all, these estimates are being brought to you by a blog post by someone who's really a staunch enthusiast of Ethereum, and they're clearly very well educated in Ethereum. While the writer of these estimates themselves calls themselves bullish, in fact, they say, "I remain as bullish as ever," they do also say that, quote, "a contentious and panicked unlock event with large profit taking could, however, be market destabilizing and a relatively long-lasting event." They're in effect warning you of the danger to come. Now, even though they are bullish because they see Ethereum as a once-in-a-generation investment opportunity, the excess supply that we could see through both partial withdrawals and full withdrawals could substantially destabilize the Ethereum network if we don't have a clean bridge and a limitation on how much people can withdraw from the network. Some folks think that I'm just fudding, that no worries, there's plenty of volume to absorb all of the Ethereum. That's true, but now, and again, that may be true, I should say. I shouldn't say that is true. That may be true, because now you have to consider the fact that macro is not your friend. This merge should have happened during a bull run, or at least wait for a bull market, because here's what you're up against. You're up against a NASDAQ that just barely went above a 23.6 retracement and is already falling below that support again. You're in a very difficult macro market. Why is that? It's because the Federal Reserve, rather than printing money and sending helicopter money to everybody, so that way they could provide that volume for those sorts of lockups that people believe are going to come, or that lockup buying that's going to happen around lockup times, well, That is no longer happening. Why? Because if it's instead of printing and giving away money with the Federal Reserve and our fiscal systems, Congress, the president, whatever, and stimulus, what we're actually going to see is we're seeing a Federal Reserve vacuum taking money and liquidity out of the system. And unfortunately, if you need buyers during a liquidity crunch when people don't have a lot of money, unfortunately, you're going to probably see prices decline even more. Now, I'm going to link down below in the description the video that I originally made on the Ethereum-merge to warn about this potential happening. That is what could happen after the merge. Now, why are prices going down now, and why is Ethereum falling more than Bitcoin? Well, I believe Bitcoin's roughly 12% decline is roughly what you would expect for the macro contraction that we're seeing in stocks as well. However, the additional 8% or so you're seeing with Ethereum, in my opinion, is a combination of buy the rumor, sell the news. The event happened, we were there for the event, we had our party, now we're selling and we're moving on to another buy the rumor, sell the news event. But you are also pricing in the fact that there's probably going to be a post-merge sell down during a time of a lack of liquidity. Now that's very unfortunate because I don't believe Ethereum deserves that. I think Ethereum has probably one of the strongest systems for transactions at the lowest potential cost. Unfortunately, if macro and post-merge liquidity are reasons 1 and 2 for pain, the next reason is we have to remember that blockchain technology does not equal market capitalization value. Think about what I just said. The technology of a proof of stake system is not equal to the value of all Ethereum. That's very, very important. Hey, if you like the perspective that you've seen throughout this video so far, make sure to check out the programs on Building Your Wealth link down below. There's a coupon code expiring at the end of the month, and you can get lifetime access to the courses on building your wealth with real estate or stocks or being a real estate agent, doing property management, you name it. Link down below. There's some amazing ways to build wealth, and now is the best time to start learning to build your wealth so you can get started, in my opinion. The difference between these two things is blockchain technology is what we have. It's the code. It's what we can transact on. It's really, really good at being secure and for anybody across the world to be able to transact money. But that system, along with all the other things that we could do, like NFTs and all the derivatives that come off of this through other layers, right? But the difference is that is kind of like a business, right? If you were to value that technology, you'd kind of value it like a business. And if you value it like a business, you look at it and say, okay, what's the utility for this, right? And if you're comparing the utility of this, you compare the utility of Ethereum to other things like the existing banking system, which many people in crypto absolutely do not like, and that's fair. But the point is, it's going to have some form of value. And you have to ask yourself, is that value for Ethereum and the Ethereum network worth $169 billion? Okay, there's a company called Invitation Homes. They own like 50 to like 80,000 homes. Ethereum right now has a market cap that is in excess of 8 times as expensive as Invitation Homes. That would be like 400,000 homes, right? It's pretty remarkable. So, and I mean, that's up to you to decide whether or not that is actually reasonable. But then again, that's not the only reason people buy Ethereum. It's not like you're only buying Ethereum for the blockchain technology. That could have a fundamental value. That fundamental value could be $2,000 per Ethereum. It could be $1,000. It could be $10, right? $10, we'd be sitting at about 1/100th of the value of where we are now, and we'd be looking at about a $1.6 billion technology, which is maybe the value of Redfin and Open Door combined. Kind of interesting when you put it into that perspective. There's a lot of extra value put on top of this technology, and unfortunately that extra value has a lot to do with speculation, and it is that, well, crypto went up during a stimulative time. Hopefully when the Federal Reserve U-turns, then crypto will also go up again. And the day-to-day fluctuations of the stock and crypto market will tell you that yes, eventually crypto will go up again. We just don't know if it'll go up from 1,300 to 10,000 or if it'll go from 300 to 500, right? We have no idea. And I'm not making any kind of predictions, but this is where a lot of folks have to remember that, hey, cryptocurrency was always thought of as an inflation hedge. That is something that would become more valuable during a time of high inflation. The problem is when you take away liquidity, you depress speculative value. And so what we've seen is stock market values come down. Now we're seeing real estate values come down. Cryptocurrency prices come down. Speculative valuations are coming down somewhat back to reality because liquidity, money in the system, is being taken out. And this is actually why cash right now in this kind of market is a better hedge than any kind of investment against inflation. Because if you have cash that you need to buy assets, real estate, crypto, stocks, well, the more prices go down, the more valuable your cash becomes. It's all dependent on what you're comparing the cash to. If you're comparing the cash to grocery bills, well, then obviously your cash is becoming less valuable. Now, of course, we know that there are other issues going on in the cryptocurrency space as well, like the fourth issue, which is regulation. We talked about the stablecoin disaster. I've been warning about the stablecoin disaster for years at this point. But more importantly, we've got to realize that the SEC is honing in on things like tornado cash, which I've also talked about before, and honing in on other aspects of crypto that mean the next bull cycle could be faced with a lot more regulation. Now, hopefully that's a good thing, because then we can finally remove that as an element of fear, uncertainty, and doubt. Anyway, these are my thoughts in terms of what the heck is going on with crypto. If you've liked this content, make sure to subscribe to the channel. Check out the links that I referenced down below. And folks, we'll see you in the next one. Goodbye.